My name is David Green. I'm the Senior Trust Officer at First Covenant Trust and Advisors. Today, I'm going to be talking about how to take advantage of the potentially fleeting opportunity that we have with the estate tax exemption at the level that it's at today. If you haven't seen my earlier video on the estate tax exemption and where it's been and where it might be going, that may be helpful for some background and context for what I'm going to be talking about today. One of the big questions is if the estate tax exemption is going to be shrinking in the near future, and I think we all expect that will happen, at least in a few years and potentially sooner, as we discussed before. What do we do to utilize the exemption while we have it? Now, this is a question that many people don't need to grapple with. The estate tax exemption now is $11.7 million. Even at reduced levels, it may be $3.5 to $5 or $6 million per person. So still high net worth families that are worried about this tax. But when this tax hits, it hits pretty hard. The current tax rate for the estate tax right now is 40%. It's been as high in the recent past as 55%. So when you're an individual or a family that is subject to the estate tax, a little planning can go a long way because the tax rates are high. So one of the things that that higher net worth families may be thinking about is how do we take advantage of the opportunity that we have while it still exists? And one of the questions that comes up is, hey, if we do planning today and Congress and the administration pass legislation later this year, is it possible that could be retroactive and render ineffective some of the planning that we've done earlier in this year? And that's certainly a possibility. The commentators that I read and listen to don't expect necessarily that any legislation would be retroactive, but it's possible. So one of the things that the lessons or the takeaways for planning individuals is, let's get this done as early as possible to take advantage, if at all possible, of the opportunity that we have today. And there are lots of different techniques that are fact-specific, depending on the particular family and the particular goals and the particular assets that we're dealing with. But in general, a couple of the techniques that we might use to take advantage of a higher exemption while we have it could also be an exercise routine. I jokingly refer to this as the squeeze, freeze, and burn technique. And the squeeze part talks about taking advantage of valuation discounts, which really just reflect the economic reality that if you're in business with other people and you don't have full control of an asset, it's worth less to you than it would be if you had full control. Another reality is that if you can't go and sell your asset to whomever you wish, it may also not be as valuable. When you're involved in the gifting process, and really what we're talking about here is gifting assets early so they are removed from one's taxable estate and given to another. And trusts are a valuable way and a tax-efficient way of making those transfers. So we can utilize the valuation discount to nominally reduce the amount of assets that we're transferring. And so what we do as planners is we look at the different assets that clients have and say, are any of these potentially subject to valuation discounts? And so we're able to squeeze more value through the exemption that we have today and pass that to future generations by taking advantage of the discounts that are available. Now, if you're a high net worth family and giving assets away, even with the valuation discounts that are available to you, is not enough to get you out of an estate taxable situation, one of the next things that we can do is sell remaining assets to the same trust that we have gifted to. And typically in this situation, we utilize a grantor trust, which is a trust that for income tax purposes doesn't really exist, but for estate tax purposes is a separate entity that's not includable in your estate. And that's the freeze part of the technique. Essentially, this asset that I have that has been growing, right, to create the estate that I've got today, typically the growth rates that we see on high net worth families' holdings are generally in excess of 10 and sometimes even 20%, right? So these estates are large and they're growing at a rapid clip. Well, what we want to do with the freeze technique is to move that growth from the environment where it will be subject to estate taxes in the future and move it to an environment where it will be exempt. Essentially, we're going to pay tax now, hopefully at a zero rate, because we're utilizing this exemption and putting it in an environment where it's not subject to estate taxes in the future. The freeze part comes because that growth in the future is out of our estate. The note that we take back is a fixed amount, right? The interest rate is typically fairly low, and in today's interest rate environments, they are. And the value of that note decreases over time as payments are made from the trust back to the family. The burn section of the technique has to do with the person who has put assets in the trust still being liable for the income tax that's generated by the assets that are in that trust. And at first that seems like a bad deal, right? Why do I want to continue to pay income taxes on assets that are generating income that I've given away? But if you think of it as making a gift to someone else to pay income taxes that they would otherwise have to pay, and being able to make that gift of cash to those people to pay those taxes, gift tax free, that's essentially the environment that the grantor trust creates. You're paying tax on income that's attributable for estate tax purposes to someone else. So the result of this is your estate is significantly reduced. The growth of future assets that may have been subject to 40 or 55% estate tax rate has been removed from your taxable estate. And you continue to shrink your taxable estate as the value of the note decreases and as income tax payments are made for the benefit of your beneficiaries. The other great benefit of this is that these trusts are typically designed so that they can go on in perpetuity, right? So this estate or transfer tax-free environment is not just good for one transfer, right? It's not just good for your generation passing the assets to the next. If the planning is done correctly and then executed correctly as the generations go forward, the estate tax can be paid once by you, hopefully using as much of this large exemption to pay a 0% rate as we can, and then creating a transfer tax exempt environment for generations to come.